Hello everybody. In this video, I want to talk about why I am not invested in the S&P 500. It's a topic I've pretty much been avoiding so far on this channel. It just happened this way. But also, it's kind of controversial, and it's very controversial. And it's kind of political also. It's just a difficult topic to tackle. And more than talking about just a specific company, but I feel the time is due, and we really need to talk about it, and I need to and explain myself. And towards the end of the video, I will also explain why I'm now considering maybe to put a small position in the S&P 500. So it's kind of a time for me to really talk about it. Hi, if you're new to this channel, my name is Alex. I'm a retail investor. I have done a little bit of value investing, and now I'm focusing more on the dividend, on strategy with dividends, where I buy dividend stocks, which are, I think, have some kind of an upside, be it they're really undervalued, or I just think there is an opportunity for maybe a little swing in the price. And on this channel, I share my investing journey. But I am not invested in any index funds, and specifically not in the S&P 500, and I want to explain why in this video. So in this video, I'm gonna talk about 4 reasons I'm not invested in the S&P 500. They are all intertwined between themselves, and there are gonna be some overlap between the story and the reason and the explanations inside each reason. So it's more like a one big long story. But yeah, I'm gonna divide it like into 4 reasons. And the way I want to do it is begin from the easier, more banal reasons where I have less to say also, because it's known and it's nothing really new. And those are also somehow the weakest reasons for me. I'm gonna start from them, and then I want to get to the more heavy reasons, which are more significant for me. And there I also think as something, I don't know, completely new, but maybe a little bit more original add to it also. So let's begin. So reason number 1 I am not invested in this S&P 500 is concentration. Again, I'm beginning from the easy, more banal reasons. So when you are invested in the S&P 500, you expect to be invested in the 500 largest companies in the United States, the largest economy in the world, hold the whole economy, and have the big diversification when you enjoy from the growth and the prosperity of all the companies in this index. But what happens de facto is the index is very concentrated, and 37% of your money goes into these largest top 10 holdings, where 7% of your funds go to Apple, and then 7% to Nvidia, and then 7% to Microsoft, 6.5%. So it's not as diversified as you might initially think. It's both has 2 big of positions maybe in specific companies, and it's very, very highly concentrated in this one sector currently, which is obviously the technology, the big tech companies, and which is a problem of its own, because currently it looks like nothing bad could ever happen to this sector. But believe me, mark my words, someday something will happen, and the market will be disappointed from this sector, and something will, I don't know when and I don't know what. But it will not be always as shiny as it is right now. So yeah, the very high concentration. Again, as I said, I'm beginning from the weakest reasons. That's not the biggest reason for me. If it was only that, I might have considered investing in the S&P 500. The thing with the concentration is it's always has been like that. And currently the biggest companies which are the big tech companies. But if you look at the S&P 500, 20 years ago, 40 years ago, 60 years ago, it was other companies, but it was also highly concentrated in those companies, and still it did really well. And those are the largest, strongest, most successful companies in the United States. So I'm not sure that's for itself is a reason not. And my biggest problem when I look at those companies, obviously very good companies, and maybe better than the ones that I hold. And my biggest problem when I look at those companies are their valuations, which brings me to reason number two. I'm not invested in S&P 500. The valuation. Those great companies are very, very richly valued currently. I think all of them, maybe except Google. And Berkshire Hathaway, I think, is also pretty overvalued currently. But if to look at any of the other companies, I think the current valuations have kind of gotten used to them, and it looks like it's the new norm, and that's the way it's gonna stay from now on. But probably not. Probably there will be a day when all those companies revert to like a 15 PE, 17 PE, and even lower if there is a disappointment from the sector, from specific company. And so my problem with the S&P 500 is the overvaluation of those top companies and the overvaluation of the index on overall. So it is not a big secret. The current PE ratio is hovering around 20, between 25 and 30 for a period now, and it's high historically. Historically, we see that the PE was it was very inconsistent historically, but again, it's kind of high, and there is all the reasons to believe that one day it will revert to going around this 15 normal PE, which it never stays around this valuation, but we see that there are periods which are more towards the 10 and even lower multiple of earnings for the S&P 500, and there are periods which are closer to 20, and then when we got into the dot-com bubble, the valuations have really gotten high, which is obviously it was a crazy bubble, and this high valuation is just because the earnings has really fallen in the great financial recession. We will look at Shiller P in a minute, which will be more clear. And now we have this pretty high PE. It was even higher in recent years, but now it's a little bit lower, but still a little bit too high. But if we look Shiller PE takes the average earnings of last year's and the current price. We see that historically with Shiller PE, it's really obvious that the market is very on its higher end of the valuation currently. It has been in this valuation only in, or even not this high, but it's gotten close to this valuation only in the Great Financial Depression in 1929. And in the dot-com bubble in 2000, and now we are approaching a very similar valuation in terms of the Shiller PE. So why is it so scary? What's the problem with the market being overvalued a little bit or a lot? And should we not invest when the market is overvalued? So I could have done a separate video, but I'm just gonna sum it up. That essentially, it depends. Like everything in economics, like my professor in the university would say, it depends. It depends on one's investment horizon and how much they are investing. So if your investment horizon is really, really long term and you're still building your wealth to retire in 20, 30, 40 years, investing in an overvalued market might be the wise thing to do, because you cannot always wait for the market to correct itself. If you have been waiting for the last few years, you would have missed out on great returns. We never know. The market could continue going up and going up. Evaluations could continue going up and going up for years before there will be any correction. So trying to time the market and waiting for a correction, and if you have a really long time horizon, it might not be the right thing to do. But if someone is already retired, like I am, me and my husband are already retired and we're living off this portfolio, investing in an overvalued market is tricky. It's tricky. You also don't want to miss out on returns in the market, but also investing in a market which might correct itself in the next few years, or might give lackluster returns, or there might be lost decade for investors. We can't really afford that, and it's just doesn't align with our investment goals for the next 10 years. And so first of all, it depends on your time horizon. The second thing is it depends on how much you're investing. For whoever is DCAing, dollar cost averaging, put in a certain amount, a small amount out of their wage, out of their income into investing every month or every year, continue DCAing every month, no matter where the market goes, is the way to go. So there will be periods where the market is down and then you're managing to buy more with the same amount of money. There will be periods where the market is up and you're managing to buy a little bit less. But long term, on average, you're just buying the market, and you should continue doing that, whether the market, even if the market is currently overvalued. But if you have a big lump sum of money, and one of the reasons I'm doing this video is because I have an incoming big lump of a sum of money, which I am considering to put into the S&P 500, putting a big lump sum of money into an overvalued market might not be the way to go. There is a dilemma here. I can understand whoever is deciding to do that, because if not, what else could you do? And it's all a matter of alternatives. Sitting on cash this year's also obviously it's not a good idea with the amount of money printing and inflation, and protecting yourself only from inflation. Also, you kind of want this extra return to make your money work for you. So I understand if someone decides to put a big lump sum of money into this overvalued market, but for me, which I am an active investor, this is what I do. I have the time, I have the knowledge. I hope and to find something that is will hopefully is less risky than an overvalued market. So what are the risks with an overvalued market? What is the biggest fear? What could happen? I think the biggest fear when you see that the S&P 500 is overvalued, the biggest fear is a correction in the stock and in the price of the index, which might be around 20%, 30%, 40%. Worst case scenario, probably 50%. That's going to be really serious depression, and it's going to probably not be for long. So as long as you don't sell on this 50% decline, it should probably not stay really depressed by 50%. Even if there is such a huge correction, it's probably going to be temporary anyway. I think 50% is a little bit stretch. It could happen, but again, if it does happen, it's going to be only for a short period of time. I believe so. But the correction of 20-30%, I think, is kind of overdue in the market. So if that's the biggest fear, it's really not such a big fear anyway, because if you've been in the S&P 500 for the last few years, your returns would have been so stellar and so great that the now correction of 20% is really nothing compared to it, and it's completely okay. And of course, you cannot expect to always be in the green and every year to be positive. Correction of 20-30% is absolutely normal. And of course, when you're investing in any kind of stocks asset, then you should be prepared and ready for it, and know that there will be up years, there will be down years. So it is a risk, but for me, again, this correction, my portfolio has been down with these stocks. I picked much more than 20%, more than 30%. And as long as you see the way out, and you're not selling at the bottom, and you should be fine. I don't think it's such a scary risk. The biggest fear for me is more of a lost decade. It might be more than a decade, where essentially what you're getting out of the S&P 500, of the index, of the market, is no return at all. And this is for me the scariest, because I need this return. I need to live off this return. And I'm not expecting to have a positive return every year, but I also cannot really afford to myself to have no return for 15 years now. And that because I am already retired. So again, if whoever has a time horizon of 30, 40 years, yes, investing in this S&P 500, even in an overvalued market, even with the perspective, with the risk of the last decade, could be fine. You know, you'll be there with this decade. You have been there in the last decade, which was amazing, and there will be more decades which will probably be amazing too, right? We'll talk about that in my next point. Maybe yes, maybe not. But you will be there in different times in the market. But for whoever is already retired, taking the risk of the S&P 500, let's look at it for a second. So this is a historical graph of the S&P 500, and I have to say that's on macro trends, and I have to say that you look at sometimes at different graphs of the S&P 500, and I feel like they sometimes, I don't know, they organize some in some different ways where you see a little bit of a different story. So this one, it's more on the extreme side, but here on this graph, we can see that after the bursting of the bubble in 1929, it took 30 years for the market to recover. And if you have invested in 1973 before the oil prices, the embargo, and all of that, and you have been broken even only after almost 15 years, 13 years. And if you have invested in the peak of the bubble, in the overvalued market in 1999, just before the dot-com bubble has burst, according to this graph, which I have to say, I think I've seen other stories on other graphs, so take this with a grain of salt, but it would take you 15 years to just break even. And even when you just kind of almost broken even in 2007, here came another recession. So it was a really difficult time for investors. And we might face another period like that. I mean, for sure, someday there will be another recession unless they print money like crazy and just inflate the recessions away. But this will be very risky for the currency. But there will definitely be a recession someday. How long will it take? If it could only be like in 2008, when it took only 5 years for the market to recover, and since then it went bonanza again, mostly due to money printing and inflation. I could live with that. My fear is having this lost decade, 2 decades of no return at all, where it's one thing that my portfolio is down, but it's another thing that it's gonna take for it 10, 20 years to just break even, and essentially I have done nothing at all with my portfolio, with my money. My money has not worked for me. And then you say, okay, it's only 15 years, but if you stay for the long term, it's okay. I'm almost 40 now. I know I look much younger. And thinking that I will be only broken even in when I'll be 55, even if I was yeah, still working and still DCAing. I don't know. It's just I don't know. It's not something I feel comfortable with. Another discussion that could be had about it is whether me that I'm picking stocks and I have a portfolio of individual companies that I chose, whether it will perform differently from the S&P 500. If the whole market is down 50%, my portfolio would probably be down also. And if the whole market is not performing for 20 years now, I need to work really hard to make sure that my portfolio is working, because obviously it has its own beta, which is this correlation to the market, and probably if I have big enough of a portfolio, it's going to probably go in the direction of the market and give me returns which are very similar to the market. So I'm not saying that if you don't invest in the S&P 500, you're safe from those risks. It's pretty hard to avoid those risks, but we need to be aware of them. So that's reason number two. I am not invested in the S&P 500. And as I said, those have been pretty weak reasons so far. Those are not the main reasons I'm not investing in the S&P 500. If it was only the concentration and the valuation, I would have probably invested at least some portion in it. I mean, not avoided it at all. And obviously, during the last even decade, we can say it has done magnificently. even though it's highly concentrated and even though it was pretty overvalued for a few years now and still it continues to do pretty well. So yeah, so again, even if you have a lost decade, even if you do have a correction long term, you're doing probably fine if it was only those reasons. So now I want to talk about the true reasons, the strongest reasons, and which will take me more time to explain also. Oh my god, I'm already 30 minutes into this video. It's not going to be short. And of why I'm not investing in this S&P 500. So the third reason I'm not invested in the more juicy one already, and is the expectation of future returns. What returns are you expecting from the S&P 500 going forward from now? It's a very difficult question. I do feel it's very controversial. We do feel it's political also. So I'm trying to discuss it because there's so much to say on it. And I've kind of began to research it and I want to research it more. It's very important. And I want to show you a few things about it and kind of articulate my thoughts a little bit and show you just a few things overall, and yeah, people are expecting the market, the experts, everybody is expecting a S&P 500 to do around 10% with inflation in real terms, around 7-8%, and which is based on what? I'm not sure. I'm not saying it's completely lacks any basis, but I'm not sure what this basis is. And trying to like peel a little bit and the layers and trying to look at what drives the growth of the S&P 500 is pretty complex. I feel the information is fragmented and very unreliable. I kind of look at everything with a big grain of salt. I think there are a lot of biases and agendas here also. Uh, so it's difficult to understand, which we'll get in the end of this video. But overall, S&P 500 has given around 10% historically. But as we've seen, it hasn't been for every period you look at. There are periods where it performs amazingly, like the last 20 years. And the periods when it did nothing at all for investors. So first of all, we need to be aware of that. And today, when I talk about it with people, they kind of forget it all. They only see the last 10 and 20 years, which have been absolutely crazy. And everybody feels rich now from just investing in the S&P 500. And for me, it's so obvious it's unsustainable. And the S&P 500 will not always give those kind of returns. But what do we expect the S&P 500 to do from now on? So there is if you look at the growth of the price of the S&P 500, you have two factors into it. One is the valuation, which grows, and the EPS earnings of the companies, which also grows. And so, first of all, during the last few years, we had the growth in the EPS of the S&P 500. And we had the growth in the valuation also because we've seen that now the index is very, very richly valued. So first, let's look at the growth of the EPS without the valuation to look what is the internal inherent growth of the EPS during the last decade for the S&P 500. So the EPS, earnings per share of the S&P 500, first of all, this is the graph. We can do the log version to see it a little bit more normalized, the logarithmic version. Yeah, we see that the EPS is growing and it's growing nicely. So it's not just the bubble and I haven't talked about the bubble. So it's not just that there is this bubble where the valuation is inflating and inflating when essentially the inherent asset is not yielding and not growing at all. So we see that there is growth in the EPS of the S&P 500, but how much? Let's look at how much and try to dissect the different factors, the different elements that contribute to this growth, and trying to understand what drives the growth of the S&P 500 and how should we think about it going forward. So again, we see that there is this growth, and this is Guru Focus. I'm gonna take into account that maybe some of the statistics and the numbers we see here are not accurate. we should really check more sources and compare. But today we're gonna look at the focus, which until now I think has been a pretty reliable tool for me. Um, here we can see the different financials for the S&P 500, and we can see the top line is the earnings per share. Should I increase it a little bit? Maybe like that. That is easier. And is the earnings per share, which was that the 10-year growth of the EPS of the S&P 500 is 6.5%. And so this is 10 years, and we should really take into account that we've been in a crazy bull market. It's not always gonna be like that. So in a crazy bull market, the EPS growth is 6.5%. And here we have a statistic, which is an average annualized growth rate, which they don't say for how long it is, but I have already kind of spent quite some time here. And I think it's about 20 years. And as I know, we focus, and I've looked at this statistic for different metrics. So we're going to look at this soon. And I think this is for 20 years. So we've seen that for a longer period than 10 years, the growth rate of the EPS of the S&P 500 is only 4%. So why should we expect a return of 10%? And this is not in real terms. If you exclude inflation from it, which has been also higher in the recent decade, but let's take a 2-3% normal inflation, which I do not believe is going to be the future inflation in the next decade or two. I think it's going to be higher. Let's say it's going to be 2-3 normal inflation that the governments are always striving for. We see that in real terms, it's almost nothing, really. So this is the growth of the EPS of the S&P 500, and the growth in the earnings per share is also comprised of three key elements. The first is the growth in revenues of the companies. The second is the growth and expansion of the margins. So so even if sales are not growing, if the margins are larger, then the company is making more profits. And so the revenue growth, the margin growth, and the share buybacks. So the share buybacks have been pretty dominant in the field, especially in the S&P 500 scene during the last decade. And we're gonna see that in a minute. So here I have a graph actually from JP Morgan showing from 2001 until 2022 how the different components of the EPS growth of the S&P 500 contributed to its growth. The gray bars are the margins, the green bars is the revenue growth, and the blue bars are the difference in share count, essentially share buybacks and share issues. So if you just want to pause and look at it, but we're going to look at it on the Guru Focus also from a different angle that will give us a little bit more numbers to work with. So getting back to the table I showed before, we've seen that the EPS growth the last 10 years, and let's take always into account that if we take the last 20 years, it's going to be less. Okay, I can open a different separately each tab and look at the average long-term growth to see that it is lower than the growth during the last 10 years, because again, we've been in a crazy bull market. So the historical growth and I think the expected future growth, which is more aligned with the historical growth, are actually lower. And so we've seen that again the EPS has been growing for the last 10 years for 6.5%. While the revenues, we see that have been growing 4.75%. So this is the growth in revenues for the last 10 years for the S&P 500. And if we look at net income, it has been growing for 6%. So the delta, the difference between the 4.75 and the 6% is essentially the expansion in margins. The revenues has grown only 4.75%, but the income has grown the earnings 6%. So the difference is the expansion in margins. And then from the 5.9% growth in earnings to the 6.5% growth in EPS is the share buybacks. This is earnings not per share, and those are earnings that are per share. And we see that there is around the 0.6 difference here, which is accountable to the share buyback. So we can also see that in sales, here we have the sales per share, which are 5.27, while the revenues growth is 4.75. So again, we see this 0.5, 0.6 difference, which is accountable to share buybacks. So now that we know that, let's try to think together what should we expect going long term from here. First of all, I cannot in any way justify an expectation of 10% of a return from the S&P 500. Seeing that again, this is 6.5% for the last 10 years, but actually it has been 4% longer term. Again, I think this is 20 years. They don't say that. I'm gonna look for a statistic maybe later to see another a number, maybe on another from another source. But the long-term growth of the EPS of the S&P 500, which is not as stellar as people think. And this is pretty much what has been until now. But is what has been until now is going to go further from now, which brings me kind of fluidly to reason number 4. I'm not investing in S&P 500, and the answer is I do not know. I don't know. The fact that the S&P 500 has been returning around 10% for, I don't know, whichever period, doesn't mean it's gonna return that in the future. Of course not, and nobody says it does, and they always say that the past returns are not indicative of future returns. But more than that, I think betting on the S&P 500 to give 8, 9, 10% in the future, we need to think hard what we're betting here on and whether we should want to bet on it. And it's completely okay if someone does want to bet on it. I personally, I do not feel comfortable with it, because just trying to figure out what would be the factors and the elements that affect the growth of the S&P 500 in the future is really, really hard for me. It has a lot to do with the growth of the economy of the United States, which has been a lot slower. When we look at historical data from the 19th century, well, the 19th century was a crazy expansion period for the United States. After the World War, and overall it became a world empire. Obviously, its growth has been slower of the economy, but somehow it did not project itself into the growth of the S&P 500. So the S&P 500 might be the 500 largest companies in the United States, but they're not exactly equal to the overall economy and to the growth in the GDP of the United States, because they consist a little bit of different elements. I really try to understand what makes this difference. So like things like international sales, which are not in the GDP of those companies, and the government spending, which is versus the consumer spending. So there are kind of different elements and the difference between the growth of the GDP of the US of the United States and the growth of the S&P 500. But still, I can't say I understand it absolutely deeply, like I have all the answers about it. But again, assuming that the GDP is not growing and is slowing, the growth of the GDP is slowing and slowing in the United States, but will it affect the S&P 500? I don't know. I understand that it didn't so far, so one might say that it will not affect it in the future also. I mean, I'm having a hard time believing it's not related and correlated at all. So that's one thing. And the second thing is that we see that the growth has not been as stellar, at least from what I gathered so far, as one might think, as it looks in the price of the S&P 500. Yeah, maybe getting a little bit too into politics, but Do you want to bet on the United States? I mean, someone will, some will not. It will not. Maybe someone thinks that the United States will kind of decline and the economy will weaken. Maybe someone thinks that it will continue to be the strongest nation in the world with the strongest currency and the biggest companies with the heart of the world capitalism. So it's kind of a bet on macro issues also and all the geopolitical situation on like globally, which is not something that I would want to bet on and to invest in. And I just want to say that if it was an individual stock, like one company, that its future performance would depend on like this very uncertain geopolitical scene. All kind of investors from different schools of thought would say that I don't want to bet on it. It's too difficult for me. Let's find something simple that I understand. But when it comes to the S&P 500, that's okay. No, I still don't think that's okay. The same uncomfortable feeling I would have had holding stock that is dependent on all those external factors and macro issues and geopolitical situation, and is also kind of I feel the same way with the S&P 500. So although the S&P 500 is just like holding the 500 largest stocks in the United States, and it just looks like an innocent basket of stocks, I think it essentially takes the form of a new kind of asset that has different characteristics, a different behavior that we should understand that might not necessarily reject into a specific stock inside this basket. When we put all those together, it kind of gets a life of its own, characteristics of its own, and we should really analyze those characteristics and think whether we want to invest in them. Again, it's everyone's personal decision. I prefer to invest in things I understand, and I cannot say I understand well the S&P 500. I think a lot of people that invest in it, first of all, there are a lot of people who invest in it just because without understanding, without even knowing, they have the money managers, or a lot of passive investors are just building this portfolio because that's the best practice, that's the general advice, without taking really into account those risks, the prospects, the future growth. I mean, for me, there is no investment thesis here. I mean, this channel is called in my investment thesis because I want to understand what I am investing in. And I want to go to sleep at night and know that why I expect, and of course, it will not always turn out as I expect, but at least have some kind of an expectation, some kind of a story of why I'm expecting and good, nice, fine returns from a specific asset. And I simply don't have that with the S&P 500. I don't understand why should I expect a return of 8, 9, 10% from it going on from now on, and except that it did so far, this return. I don't know, for me, that's not good enough of a reason. And so yeah, so that's S&P 500. Before I add a few things more, because why not? But this video is already too long anyway. And I want to show you a post I found on Reddit. I was researching why the growth of the economy is so different from the growth of the S&P 500 in the United States. And it turns out it's not just in the United States, it's in many countries. The main index of the largest companies gives much better returns than the more slower economy in developed countries, the growth in the GDP. So there is this difference. So this is a Reddit post where someone asks about it 6 months ago. How does the stock market grow faster than the economy? And here there is an answer, which is the top answer from someone that I somehow figured out later. This user is pretty active on this forum. It's a Reddit subreddit, Ask Economics. And where they explain why the S&P 500 is giving more than the economy. And they have this explanation, which is the most upvoted comment. And they explain, suppose a company doesn't grow at all, but makes a profit of 3% of its value. That stock has yielded 3%. Now suppose that during the last year there was a 3% inflation. The real return is still 3%, but the value of the company as expressed in dollars is also 3% higher, just because the value of the dollar has declined. Now suppose that the company has actually grown 3%. So you have the 3% profit, the 3% inflation, the 3% growth, which gives you a 9%. And which is close to the 10%. And actually, I read that and I was just thought, huh, okay. I mean, it really managed to confuse me. Like for a second, I really think to it and I thought about it and it really managed to confuse me and I slept on it. The next morning I was, what? It makes absolutely no sense. The fact that an asset is given 3% internal yield of its profit, it does not raise its price. I mean, this individual here is asking, why is the S&P 500 growing by 10%? The fact that the S&P 500 is yielding 3% does not mean it's supposed to grow, but this 3%. I mean, I don't know if I would have given an example of a house I bought and I'm renting it out and it's yielding, the rent is yielding 3% for me. The 3% yield does not mean the house will be worth 3% more every year. The fact that there is a yield does not contribute to its growth. And the fact that this is the most upvoted reply to this question, and nobody really disputes it here. And obviously this is just a subreddit, and people are generally just trying to learn here, and I don't believe there are big economists and experts here, but still, it just goes to show how people do not understand really the S&P 500 and the drivers of its growth, and what are the expected returns from it, and what are they investing in. And the fact that we got this confusion also just goes to show how complex it is, and it's not easy to understand. And the moment I give the example of the apartment, it's very easy to understand, right? But when it becomes an index, it's suddenly our minds are having much more difficult time to process the information and to understand it and to dissect all the different elements and really understand this asset. And so yeah, so this is the S&P 500. Those are my four kind of and a half. I hope I added the bubble thing. Yeah, for not investing in the S&P 500, and that's why I'm not. I used to hold it, and I actually sold it out completely because out of all the assets in my portfolio, I was really not sleeping well with it. I know it's it's a very unpopular opinion, but yeah. So just a few things. I know this video is already long. I initially planned to make a separate video about each reason, but I said, okay, well, I'm going to just do it all at once and move on. But I do want to just add a few reasons to do invest in the S&P 500 for me, and talk about my decision that I have to make now about it. And so to contrast the reasons I gave so far for not investing in the S&P 500, I want to say what are the most compelling reasons for me to do invest in the S&P 500. And I want to mention two reasons which kind of go beyond the obvious ones, like that I have this passive investing and you have to do nothing, that it's keep it simple, stupid, and that it takes much less of your time, that you're paying less in fees, obviously, and less in taxes, and you're not buying and selling, you're not trying to time the market, you're kind of got you out of the way. But for me, there are two reasons that I wanted to add to that do affect me considering to do invest in the S&P 500. So the first one is that long-term markets go up, but companies decline. So if you invest in the S&P 500, it's going to still be there in 20, 30, 40 years. But if you invest in an individual company, it's very, very probable that it will somehow face difficulties and decline and might even go bankrupt in 20, 30, 40 years. So although even if you build a portfolio of value stocks or dividend stocks, the saying goes that time is working for you, you need to be really, really careful and know when to exit because really, if you just leave it like that and do not maintain your portfolio, time is going against you. Because if you look what were the most, I don't know, let's say top 10 companies in thing with this video in the S&P 500 20 years ago, 40 years ago, 60 years ago, some don't exist at all, and for sure they're now not in the top 10 S&P 500 stocks. And if you even if they did not go bankrupt, and even if they're still big and strong companies, and for most of them, if you look, you would see that investors did not do really well with them. And so, yeah, so kind of time works for you when you're in index funds, but I'm not sure. It's tricky to say how time works for you, or maybe even against you when you're in individual stocks, because again, companies long term they decline. There is a life cycle of a company. There is a book I'm planning to read. I haven't read yet. It's one of my next ones. The Living Company, that talks about the life cycle of a company, and which is really fascinating. And of course, it can take 5 years, and it could take 150 years for this cycle to manifest itself. But again, long-term companies are eventually dying and declining. Of course, not all of them, but almost all of them. So that's reason number one to do invest in the S&P 500. And reason number two is just a feeling. It's something that it is irrational, completely irrational, and I admit that. But that's the fear of high inflation. And I think we've gotten into a period where the fiat currency is kind of going rampant, and the governments are getting more and more addicted to printing, and therefore we see higher and higher inflation. And it kind of seems like now every bump that will be along the way in the market, this inflation and money printing will be the solution. And for me, I cannot explain why, but somehow it feels for me like the S&P 500 is a better protection against that than individual stocks. Maybe the reason I'm saying that is because there was high inflation in the recent years, and the S&P 500 really skyrocketed a lot of it due to the inflation, but my portfolio did not. So maybe just it was my some kind of unsuccessful stock picking for me. It was definitely that also. But I don't know, somehow the S&P 500 is for sure gonna protect you against inflation. I'm not saying hyperinflation, but just high inflation, or of normal inflation, or just normal inflation. It's a good protection. And when you build an individual portfolio of individual stocks, I'm not sure yet. I need to think about it, and I need to plan it in a way that will protect me also against inflation. I need to think about it. But yeah, somehow, if I'm scared of high inflation, I think S&P 500 is the place to be. And so yeah, so that's the two reasons to do invest in S&P 500 for me. But beyond the passive investing, that you don't need to work hard and do anything to make hard decisions and to pay extra fees, and you probably will still not beat the market, right? Yeah, so yeah, so now talking about my story, I actually won a medical lawsuit and of medical negligence back in my home country, and I got the $120,000 just now, and I need to decide what to do with it. And because of my lackluster returns in the recent years, my husband is kind of keen on let's he says, let's put this for now in the S&P 500, although he's very optimistic about my new strategy with the dividends. And no, he believes in me and everything, but he's just like saying, let's diversify. You have this portion in your portfolio, and let's just put some portion in the S&P 500, because of course he always hears how that's the best thing to do and the best practice, and that's the general advice. And so we're considering doing that. So I haven't decided yet, but I did this video to just kind of dissect for myself why I'm not invested in the S&P 500, and also I'm probably gonna let my husband watch also, and we're gonna decide together. But my second option is also a CHD. If I'm into dividends, then why not a CHD? I actually like a CHD a lot more than the S&P 500. I feel I understand it more. I feel it's more predictable, less risky, and I'm probably will make another video on SCHD. So those were my reasons for not investing in the S&P 500. It's probably a very long video, sorry, Let me know. So I should have broken that into making separate video about each reason. Then I would have talked more deeply about each of them and show more material. And we might still do that one day. Let me know what you think. I'm sure most of you do not agree with me. I really want to hear your arguments. I love challenge me. I love to discuss everything in the comments or in whichever vote you like. So yeah, so that's it about S&P 500, and I'll see you in the next one. Bye bye.